Welcome back to The Explainer. So if you've been keeping an eye on the markets lately, you already know the big news. Silver just woke up from this grueling 7-month slumber. And I mean, it broke out with some serious momentum. But you're probably wondering, what actually triggered this? And maybe more importantly, what on earth comes next? Well, we're staring down the barrel of 3 major economic reports dropping on 3 consecutive days. Honestly, any single one of them could act as the spark that sends silver absolutely exploding higher or crashing right back down. Okay, let's dive into this and see exactly how the board is set.
To figure out where we're going, we really need to look at what just happened. The catalyst that completely changed the game this past week, the June jobs report. Wall Street expectations were sitting around a pretty healthy gain of 110,000 jobs, but the actual number that came in, a shockingly weak 57,000. I mean, we're talking about one of the weakest readings we've seen in months. This wasn't just some tiny miss. It was a massive jolt to the system that forced the entire market to basically instantly rethink its whole outlook on the US economy.
Literally the instant that weak 57,000 number hit the wires, traders violently slashed their bets on a Federal Reserve rate hike because think about it, the economy is suddenly showing signs of cooling off, right? So the market assumes the Fed is going to have to back off. And the result? Silver rallied hard. It broke right out above $60 and started pushing aggressively toward the low 60s. So yeah, one single unexpectedly weak data point was all it took to spark an immediate, explosive price move higher.
And this brilliantly illustrates the single lever that is controlling paper silver prices right now, expectations about the Federal Reserve. See, silver pays no interest. So when the market expects high interest rates, you can earn a pretty fat yield just sitting in cash or bonds. That makes non-yielding metals look a lot less attractive, and money just flows out of silver. But the moment those expectations flip and rates are expected to drop, those cash yields shrink, cash becomes trash, and money comes flooding right back into hard assets like silver.
Just look at how incredibly sensitive this environment is right now. Before that weak jobs report, the market was pricing in a 67% probability of a September rate hike. Right after the report dropped, bam, those odds collapsed to 50%, which is essentially a coin flip, and that happened almost overnight. This just goes to show that we are in a market balanced on a literal knife's edge, where just one data point nearly halved the perceived rate hike odds. When expectations are this fragile, price moves get violent.
And that brings us to what's coming next. The crazy thing is, the market isn't waiting weeks for the next clue, we're literally waiting days. We have 3 consecutive reports dropping next week that are going to act as direct triggers to swing these super fragile expectations around. On Wednesday, we get the Fed minutes. On Thursday, it's jobless claims. And Friday wraps it up with inflation expectations. Each one of these strikes right at the heart of the rate decision that basically controls silver.
So, Wednesday, decoding the Fed.
To really understand why Wednesday's release is so critical, we have to rewind a bit to the Fed's June meeting. Under Chairman Kevin Warsh, the Fed paused, but more importantly, they explicitly removed forward guidance from their statement. They deliberately stopped telling the market what they planned to do next, which left Wall Street completely in the dark, just guessing. Because they removed that guidance, these minutes, which are the detailed word-for-word records of what was actually said inside that room, are the market's absolute best chance to decode what is clearly a secretive and divided committee. If these minutes show they're leaning toward cutting rates, that is pure rocket fuel for silver. But if they show a committee that's still terrified of inflation and eager to hike, well, those gains we just saw could evaporate in an instant.
Moving on to Thursday, the labor cracks.
Thursday's data serves as a fresh, real-time referendum on whether last week's shockingly weak 57,000 jobs number was just a random fluke or the start of a very real economic trend. Now, what's really interesting about this slide is how clean the interpretation is. Jobless claims are our most up-to-date, real-time read on the economy. If claims come in higher than expected, meaning, more people are losing their jobs, it confirms the economy is weakening. That pushes the Fed toward rate cuts, which is hugely dovish and bullish for silver. On the flip side, claims come in lower than expected, it shows a resilient labor market. That supports tight rates, which is hawkish, and a massive headwind for silver.
Finally, Friday, the sleeper risk.
Now, most casual observers completely ignore Friday's report, which makes it the true sleeper risk of the week. But you absolutely shouldn't ignore it, because it is arguably the single biggest risk to the entire silver bull case right now. The Fed has stated time and time again that they are terrified of inflation expectations spiraling out of control. If Friday's survey shows that everyday consumers expect inflation to keep rising, it completely ties the Fed's hands. Think about it. They literally cannot cut interest rates, even if the economy and the labor market are cracking, because they have to fight that inflation first. Bottom line, if expectations run hot, silver stays suppressed.
So we are looking at a genuinely two-sided setup here.
On one hand, we could see a dovish surprise, where weak claims and tame inflation pressure the Fed to ease up, leading to an explosive breakout for silver. But on the other hand, we could face a hawkish reality, where hot inflation and strong labor data force the Fed to keep rates high, leading to some pretty sharp pullbacks. And hey, keep in mind, silver just ran incredibly fast from the 50s up into the low 60s. Moves that fast often see pullbacks simply because short-term traders want to take their profits off the table regardless of what the underlying fundamentals are doing.
So the crucial point is that we have to separate this short-term paper noise from the underlying physical reality of the market. While the Fed might dictate the week-to-week price action, the long-term value is being driven by relentless, unstoppable physical demand. Guys, we are currently in a 6-year continuous supply deficit. We've got massive AI data center buildouts happening, surging EV and solar expansion, and Chinese silver imports just hit an 8-year high. Plus, remember that 70% of silver is actually mined as a byproduct of other metals, which means supply physically cannot just ramp up overnight to meet this demand. This deeper fundamental current, it doesn't care about a single weekly jobless claim.
And when you mix this incredibly tight physical reality with sudden, sharp shifts in investment demand, you don't get polite, slow price drifts, you get violent lunges. History shows us exactly what it looks like when a coiled spring releases in this market. We saw it in 2011, when silver ran from $20 to nearly $50 in just a matter of months, and of course back in 1980 from $6 to $50 during the infamous Hunt Brothers squeeze. When investment demand hits a physically starved market, it moves with staggering speed, up or down.
Because of that extreme speed, there's a really dangerous behavioral trap waiting for folks next week. Here's how it usually plays out. Step 1. A report drops, silver spikes, and people react emotionally to that sudden green candle. Step 2. They buy at the absolute top because they're terrified of missing out on the run. Step 3. The very next day, a different report drops, reverses the trend, and they panic sell at a loss. They just get whipsawed entirely by their own emotional reactions. The only way to survive this environment is by calmly reading the data behind the price instead of desperately chasing the moves.
Let's move to the practical playbook and see how this builds a framework you can actually use. Here is your cheat sheet for the week. For the Fed minutes, if they're worrying about jobs, that's dovish and bullish for silver. If they're worrying about inflation, it's hawkish and bearish. For jobless claims, higher than expected claims are bullish, while lower claims are bearish. And for inflation, falling or stable expectations are bullish, but rising expectations definitely bearish. Seriously, keep this framework in mind so you can process these reports rationally in real time as they drop. As we wrap up this explainer, I just want to remind you that none of this is financial advice. The goal here isn't to perfectly predict the future, it's to understand the machine so you aren't blindsided when it moves. The underlying physical shortage of silver isn't changing anytime soon, but man, the short-term paper price is going to be incredibly volatile next week. So I'll leave you with this final thought to ponder as we head into this critical stretch. Between the Fed minutes, the